I just think that it's showing you that gold and silver have sniffed it out. They're sniffing out the real yields, and the big money understands that. Normally when you see the kind of gains that we saw Friday, you would expect a big sell-off on Monday. Didn't happen. It's holding very tight. It seems to have shook out all of the speculation, all of the open interest. No one even notices that gold and silver are coming back up. No one even notices that silver's back to 65 and gold's at 4,400. It's meaningful, and, corrections are necessary. It got overextended. It brought in too much froth, too much speculation. But we are beginning to see that it is quietly resuming its march higher in an environment where all the speculation is gone. They've brought their toys to a different sandbox. They're speculating in AI or whatever the hell they're doing. They're certainly not in the metals market. And the most important thing for me through all of this 6 months of difficult market action is that the central banks have bought more than ever. And look at China, right? I'm just going to read some of their purchases that they've told us about. JP Morgan or Goldman Sachs says, no, they're underestimating by like a factor of 4.5. But here are their purchases that they've declared in gold. 40,000 ounces in January, 30,000 in February, 160,000 in March, 260,000 in April, 320,000 in May, 80,000 in June, and 640,000 in July. That's what they're telling us, right? So, what is 640,000 times, call it 4,400? I don't even know if my calculator will go that high. 281,600,000, maybe that's what it is. But that's what they bought in June. So they're buying so much gold every single month as the price is doing nothing. You look at the central banks, the largest first quarter ever. The second quarter is coming in super strong as well. You look at all of the central bank buying. They said it was the most they ever bought, and they lied about it by a factor of 15, 244 metric tons. And when you talk about a metric ton, that's 244 times 32,150. That's 7,844,600 ounces of gold that was bought in the first quarter that we know of by the central banks. Call it times 4,000 even. And you're at 31,378,000,000 that the central banks have bought in the first quarter that we know of. The Bank of Korea resuming physical gold purchases for the first time in 13 years. And you get to Tether and you wonder, why is Tether buying so much gold? And, where is it all going? I've told you my thesis on that before, but, here it is again. And, they're buying more gold than anyone in the world, even more than China, except the Central Bank of Poland. And, it's crazy what's happening right now in terms of gold and silver accumulation as the price is getting beat up. I think that's really the most important thing to understand is that, over the last 4 weeks, Tether has bought 701,000 ounces of gold. And what is that? That's, almost $3 billion over the last 4 weeks. I mean, this is a crypto company buying gold. These are central banks who print money buying the one thing they can't print. Gold. The biggest money who understands the system is using the drawdown in price, the drawdown in open interest, the drawdown in any recognition. And after all of the carnage they're using it as a tool to buy it on the cheap and without people noticing. Richard Russell used to say the same thing all the time, that Dow theory would say it goes up, a whole bunch comes back 50%, shakes everyone off the bull, and then resumes. And so that's true. And we've seen it. It certainly shook everyone off. And I would also argue that the people that sold on the retail side sold for this, they're out, and they were holding it for different reasons. They sold the whole way up. I think the people that understand it aren't selling right now and have strong grips. I think you'll see the premiums in the marketplace really normalize this time up, because I think you'll get a subsection of the public interested in metals that haven't been in it before. And I would argue that a lot of people that sold came in during silver squeeze, held it for the wrong reasons, got really upset that they bought it at 30 and it fell all the way down to 18 or whatever, and finally got back up and then rode it up and sold the whole way up once it got past 50. This created the distortions, that along with the ETFs rebalancing and the 300% increase in margins, which we've talked about, along with the right in January where all the distributors had to take in the 2026 allocations. So you had allocations that require hundreds of millions of dollars to be spent across the main distributors, the public selling, the price getting killed, margin rates going up 300% was a perfect storm. That's what created the screw up in all of the premiums on this, on the bid side and the ask side, where you were buying junk silver way below spot and getting way below spot when you were selling just about anything. That's going to change. And I think you'll see it. It may not get to where it was during Silicon and Signature, where we were paying $9 over spot for junk silver from the public and $12 over for Silver Eagles. Maybe it will. Maybe we'll get close to that. But just like that was an outlier, so too is what we've seen the last few months. I think the public will start to get interested this time. And what will it be? Will it be the bond market? Will it be the stock market? Will it be a crack, via the carry trade? Who knows what it is? But I think this time those that wanted to sell have sold, and they sold into a perfect storm. So those who tried to sell and were upset by the premiums, I get it. I've never seen it in 36 years, and I think it will be different this time as metal moves higher. We've shooken off everyone that wasn't in it for the right reasons, ultimately. Doesn't mean, maybe that's not fair. Those that were holding it and didn't want to hold it for the long term, they sold. And I think that certainly removed a lot of that potential selling pressure on the retail side on this next leg up, which we might be at the beginning of right now, as it came down and silver tested when it broke out of the cup and handle, came down and tested it, and now has gone back up. That's big technical wise. Gold looks very strong again. So if you're not sure, cost average, start buying a little bit at a time, and that will smooth out the uncertainty, because of course we live in a world where logic and outcome sometimes are disconnected. Ultimately, mathematics will win, but short term, there could still be more volatility. And Tavi is right with the 50%. That is exactly what Richard always used to say. So we didn't quite get to 50 in gold. So maybe there is a little downside, but to his point, the upside might be more attractive than the potential downside.
While retail attention chased speculative rallies elsewhere, central banks were buying gold at a historic clip. They purchased 244 tons net in the first quarter of 2026 alone, extending what analysts are calling the strongest sovereign accumulation cycle since 1967. A second wave followed, with a record 289 tons bought in the second quarter, even as prices swung lower. Forecasters, including JP Morgan, now project roughly 750 tons of central bank gold buying for all of 2026. The pattern is consistent. Institutions that can print currency are stockpiling the one asset they can't print. It's a quiet vote of no confidence in paper money, and so far, the broader market has been slow to catch on.
I argue that all asset prices meet that criteria, as they are a function of suppressed interest rates. For 30 years, we had suppressed interest rates, which created these massive distortions. So you can look at the highest level, where Japan, the largest holder of our debt, is being told on our terms when they can and cannot sell. And no, don't sell. You can lend us the money or lend us we'll lend you the money. You give us your treasuries instead of selling them, which is real price discovery. We will forestall that. We'll lend you the money. You'll keep our markets safe. It goes to show the fragility at the highest level. Or go back to private equity, when you saw mass redemption requests last year that were blocked, and earlier this year that were blocked and gated by Blackstone and BlackRock and others. And now you get the CEOs or the heads of those two divisions, BlackRock and Blackstone, of private credit, resigning because they see what's coming. The issue is that distortion of interest rates has created all of these problems in misallocation of resource and capital and distortion of price discovery. And that's what happens when you mess with Mother Nature. You try to get out of the trade, and now, no, you're going to blow everything up if you do it, because we perverted asset prices through suppression of interest rates. And if you try to get out of it as rates are going higher, I mean, the crazy thing is, they are the largest holder of our treasury. They need to get dollars in order to buy yen. And what is the logical way to do that? Sell some of your treasuries. People say, you buy all this gold. Well, you need it for an event. Sell some gold to get dollars to pay off your debt. Well, it's the same thing here. What are they supposed to do? Sell treasuries, get dollars, support the yen. Well, no, you can't do that. So now we can take your treasuries if you're Russia and you aggravate us. And if you own enough of them, you're going to sell them when we tell you it's okay to sell them and how we tell you, because you're going to blow up the markets. This is, again, further, I think, eroding the trust of the entire system underneath it. What they are not saying is far more important than what they are saying. And it's sold to the public as we're being benevolent and helping our friends, Japan, to support their yen. The hell it is if the yen goes too low, their rates have to go up. If rates go up, the whole carry trade explodes and all that money goes home. And so they're not doing that. They're doing it to support our bond market and price discovery. And it goes to show the fragility of the markets when you have intervention. All interventions end poorly. It's the butterfly effect. You watch all those movies where they go back in a time machine. Now, don't touch anything. Don't talk to anyone, or you're going to alter, you're going to alter the future. Well, it's the same thing here. When they do one thing, the second and third effects down chain. Well, that's what we're seeing right now, and this is the distortion and perversion of asset prices in a period of time where interest rates in Japan and in the U.S. were very, very, very low. And too many people, by the way, are focusing just on the effect it will have on the bond market. I would argue that a lot of this money that has been borrowed at zero or behind zero, as the Japanese rates have been zero or negative for the last 30 years, has gone into high tech. It's not just into treasuries. They're buying the hyperscale build out story. So if all that money yanks home all of a sudden, what happens? And everyone is jammed in. You got the public all in on stocks to the highest level ever in 10, 12 stocks, with the largest exposure by far of margin debt. While the Buffett indicator is 240, it is way higher than it's ever been at any market peak in 2008 or 2000. So you got way overvalued markets. You got the public all in those markets at all-time high on margin and all-time high on option exposure. So they're leveraged and speculating in the handful of stocks at the highest valuations ever. As the carry trade is it's right on the edge. I mean, at some point, when does Japan have to take care of Japan? And really, the only thing that they could do to make things normal, to make a currency relevant, would be to raise rates. But that's going to create a global financial pandemic quickly. And so this is what happens when you distort things for a long period of time rather than letting the market find equilibrium between risk and interest. The bankers thought that they had a better way of doing it, and this is the knockdown effects that we are beginning to see. So the story is not over on this, and it has less to do with Japan and more to do with the fact that if Japan sells the one asset, this supposedly super, all the dollar bills say, well,
deepest, liquidest. Yeah.
It's the most liquid rails in the world. Is it really? Because look what happens when someone who's holding over $1 trillion in our treasuries wants to sell $50 billion. Oh, no! That's a problem. Flies right in the face of everything we've ever been told about why the U.S. is impossible to take over because of the liquid and smooth rails of the bond market. Is it really? I would argue it's beginning to show its fragility. It's beginning to show, it's not what we're being told. And that's a big problem. It's a big problem in a world where everything's based on confidence. And I think it's also the recognition that one of these currencies goes bust, it pulls everyone down with it. And the same thing would be true with the euro, with the pound, with the, in this case, the yen. They're all connected, interconnected. And so I guess we'll see. But it has nothing to far less. And an interesting counterpoint to all this too is that if they come in and support the yen, that they can't support it too much, right? They're trying to walk a fine line, because if they support it too much and the yen goes too high, remember all of those people who've done the carry trade that are already over on this side, and sold the yen bought the yen at zero and very low value on the yen and zero interest rates, and then they buy it, then they sell it to buy dollars to buy Nvidia and treasuries. Well, if the yen goes too high, forget about if they cap yields, but they just let the yen go high, well, the people over here have to then buy back yen at a much higher price, killing the incentive to hold the trade. So if it goes too high, the trade unwinds. If it goes too low, their interest rates go up and the trade unwinds. And so, this is alchemy. They're just trying to find the right mix, not too high, not too low. Going to sell your treasuries? No, we'll lend them to you. The whole thing is it's dizzying. And I would hate to be Shore Besant right now trying to play maestro to this orchestra.
Japan holds more U.S. treasuries than any other country, making it effectively Washington's largest external creditor. But Japan also needs dollars to defend a weakening yen, and the obvious way to raise them is by selling off some of those treasuries. Reports describe an arrangement where Japan is instead being encouraged to lend dollars rather than sell bonds outright, keeping treasury markets calm. Analysts studying the 2026 yen carry trade point out that Japan has been gradually exiting its ultra-low rate era, narrowing the gap with US rates. If Japan tightens faster than expected while the Fed cuts sharply, that narrowing spread could unwind the carry trade abruptly. Every move here is a tightrope walk. Push the yen too low and Japanese rates have to rise. Push it too high and the carry trade collapses instead.
Take the central banks out of the equation, who are buying more than ever. Same with China. You look at Tether, they're up to 20 billion, but they bought another 4 billion just the other day, over the last 4 weeks, I should say. They had 4 billion. They're buying more. Let's take all of them out of the equation. And I'll answer this in a way that I probably wouldn't answer it this way, but I'll answer it in a way maybe the mainstream would answer it. And forget about the central banks, forget about the commercial banks, forget about all the deliveries. I think that the sophisticated trader, the big money, smart hedge fund, JP Morgan, these guys are, I think they realize the irony of the market, that the broader and higher these markets go, the harder it becomes for the policymakers to ever meaningfully remove the liquidity supporting them without breaking something. And when you see M2 going to the moon right now, that's exactly what I mean. When you see intervention to keep Japan from selling treasuries, that is what I mean. When you see supposedly this little country in the Cayman Islands owning as many treasuries as they do, this is what I mean. And again, I want people to, for a moment, realize that it's not just treasuries that would be affected if Japan sold treasuries. It's not the treasury market. This carry trade has propped up the equity market as well. And I think that what you are seeing is the realization that the answer to every problem eventually becomes more liquidity, more debt, more currency creation. I think it's safe to say the era of aggressively shrinking the Fed's balance sheet appears to be over for now. What happened to quantitative tightening? And now they're adding 40 plus billion a month. They don't call it QE, but that's exactly what it is. And bailing out Japan wasn't bailing out Japan. It's yield curve control. Call it what it is. And I think long term, the debt is not sustainable. It's that simple. And I think markets are beginning to understand that. And what that would mean in a free market is that these markets would push interest rates higher. At that point, our indebtedness becomes even less sustainable, forcing the Fed to cap rates. And that's where we're at. And a rate that can no longer rise fuels inflation as a release valve. That means that real rates fall or even turn negative. And I think the market is beginning to realize that. And so you have sophisticated traders, if I were guessing, like really smart technical traders that are front running gold, because I think they understand that through all of this, you have a Fed that is trying to redefine what inflation is. And if they change how inflation is measured, they can make the numbers appear closer to their 2% target, which they haven't hit in over 65 months, creating this political and financial cover for more rate cuts and more liquidity and more printing and more buying, or the holding blows up. And I think they understand this, and they can make inflation look better on paper while everyone's purchasing power continues to get worse in reality. And again, I've said it in other ways. You know, you measure things in dollars, they're getting more expensive. Measure it in gold, they're deflating. And that's the moral of the story is inflation ain't going anywhere. Peter Schiff was right when he said that. When everyone was talking rate hikes and slowing the economy, he said it ain't going to happen, and it's going to be more and more and more inflation. And he's right. It ain't going anywhere. And, you know, I think in other words, we're going to sacrifice our purchasing power to preserve the government's power more than anything. So, I think that's the most important thing to me.
The US Treasury market is often called the most liquid in the world, yet even a fraction of Japan's trillion-dollar holdings moving to sell has been enough to rattle it. Normally, rising yields pull in foreign capital and lift the dollar at the same time. Lately, the opposite has been happening, with yields rising while the dollar falls. Some read that as fading confidence in US policy, rather than a sign of economic strength. Meanwhile, Japan's own currency interventions have run into the tens of billions of dollars in recent months, and its current account surplus has hit record levels. Yet the yen has still struggled, showing just how tangled currency, bond, and equity markets have become.
And you know, you can see that in a microcosm too, Dunnigan, because normally with the world reserve currency, when rates rise, you would see the dollar rise. And what that typically is it's a strong economy that forecasts inflation because it's producing so much and things are going well. You're going to see higher price or inflation with all of the activity. So rates are going to rise. And so you would see a lot of money come in to buy the dollar, to buy treasuries, to capture that yield. But what we are seeing lately is yields going up and the dollar going down. What that means is we don't trust you. We don't trust your policies. We're selling dollars and selling treasuries, which pushes yields up and the dollar down. Normally, they would move very much closer together. The higher yield isn't attracting more foreign capital is the moral of the story. And I was just on an interview with Francis Hunt, and he was talking about, you know, you look at the Cayman Islands, and he was talking about their small GDP, yet their massive bond holdings. And he's like, that would be me with a $250,000 a year salary holding a $66 million bond portfolio. And so it's one of these deals where, you know, there is yield curve control happening already. And whether they want to admit it or not, they're capping the back end of the bond market surreptitiously. And when they do that and yields are not allowed to rise, which is the release valve of inflation, it has to find its way out, and it will find its way out in the form of price inflation, and we will see that. And this brings us to the Cantillon effect, which says those closest to the money benefit disproportionately. In other words, a lot of that money that's being, you know, look at M2, it's going through the roof. And that is the real definition of inflation. They want to redefine inflation, get it closer to 2.5. In other words, lie about it some more. But the real inflation is happening through the increase in the money supply. It's just manifesting itself in, like the S&P, where 72% of the S&P stocks are now trading above their 200-day moving average. It's the strongest market we've seen in a while. If you were just looking at the S&P, you would think everything is fine. In other words, the things that the money is going into has not measured supposedly by the CPI. And so when that money finally trickles down to the economy, it's in the form of much higher prices, especially as things get sold off, as money is sold and then goes into the economy. It will manifest in much higher prices to the people who can't afford that the most. The wealthy get wealthier as their assets go higher, and the middle class and the poor get eviscerated as the cost of living goes much higher. And we've yet to even see these oil-induced inflationary effects. Typically, they're 4 to 6 months out. Well, when you see what oil is doing and the cost of the war and the amount of inflation, we're spending roughly $15 billion a day in debt just since July 1st. The amount of debt that is increasing is off the charts. And so inflation is not going anywhere. And so normally that would mean higher bond yields. But if the yields go up, we know what happens. And so this is one of those tightrope dancing deals that I think it's kind of scary to think how it ultimately plays out. But certainly to be cautious right now in your financial affairs is not a bad idea.